Good morning and a very warm welcome to our clients and the many other business owners that have joined us today. This is the third of our ongoing series of complementary business webinars this year. And now by joining this webinar this morning, business owners will gain a basic understanding of how a tailored financial plan and strategies, together with cash flow projections, can be used to help get you and your business through this economic calamity. I will be, in fact, showing you a step-by-step guide later on in this webinar on just how you need to prepare a financial plan so that your business can survive for at least the first 6 months after lockdown. Now, I'm going to be bombarding you with a lot of information this morning. So the duration of this webinar plus the question session at the end is going to be 1.5 hours as opposed to 1 hour that was initially advertised. So we do aim to end around about 11:30 this morning. Right, just a quick introduction of myself. My name is Monique Sharland. I'm the founder and also the CEO of the National Franchise Company Business Accounting Network, or better known as BAN, a national network of accountants that has been in business for just over 20 years. Now, I'm originally from one of the top 5 audit firms in South Africa. I've been a professional accountant for some 35 years, specializing in the small and medium business sector. And I'm also a business advisory and tax law expert and a franchise specialist. Before we begin, I'd just like to start off with our disclaimer. The information in this webinar is for general purposes only and is not a substitute or professional advice. So we take no responsibility for any actions taken or not taken on the basis of the information in this webinar. Okay, so to survive this thing, we need to put our emotions aside and adopt a growth mindset. So while everyone is being affected by the economic misfortune of COVID-19, we know that small businesses are feeling particularly vulnerable. We don't know how long this dire economic situation will last for in South Africa. And quite frankly, level 4 that commences tomorrow is not much different to level 5. And things can change literally overnight. Smokers were able to buy cigarettes yesterday morning. By last night, you can't buy cigarettes anymore. What we do know is that business owners are scared. They fear that they might not survive this crisis or beyond. They are uncertain about their future. Now, if anything, the lockdown should have changed business owners' perspective about many things in their businesses. For one, and taking this out of Albert Einstein's page, carrying on business as you have always done and making the same mistakes and expecting different results is insanity. Owning your own business is tough. It's hard work and it requires a lot of determination and learning. It's definitely not for everyone. So you might even be thinking that everything you've done in your business is just not worth it. And you may possibly be thinking the corporate employment option. So with many employees already having lost their jobs and with many more jobs on the line post-COVID-19, the chances are highly unlikely that most people can find a new job for months, if not years to come, as businesses struggle to gain ground once again. So this means that your only option is to make your business work so that you can survive this thing. But it's going to take a change in mindset. Adapt or die is an age-old adage that we're all familiar with, but how many of us have actually faced it in our lifetime? Rebuilding our businesses after COVID-19 is going to require us to think differently and do things differently. Now, even though coronavirus is not only a health crisis, it's also going to create an imminent restructure in the way we do business. Normal as we know it will no longer be normal. So the question is, what is going to be the new normal? We should focus on reimagining the future post-coronavirus pandemic. We should all be thinking how to position ourselves once this crisis has passed. And I'm really referring to is marketing positioning. So the opportunity is still there for us to plan forward. Business owners need to adopt a growth mindset as opposed to a fixed mindset. The fixed mindset is the person that says to themselves, but I've always been doing it this way. you're not going to survive with that mindset any longer. So the growth mindset refers to the underlying beliefs about a person's learning ability and intelligence. So individuals with a growth mindset thrive on challenges. They view failure not as evidence of unintelligence, but as a springboard for learning through reading, growth, and stretching their existing abilities. So people with a growth mindset are open to continuously learning, reading, evolving, and adapting to change, irrespective of what the world and life throw at them. So since we're all in this COVID-19 pandemic together, we all have a choice. We can either let it destroy us, or we can fight back and develop a growth mindset is really the starting point. So bear in mind that building a growth mindset is a continuous process, and it's not always easy. So it's natural to have your tough days, but what's important is how do you bounce back? The world is very different, and it's a very different place, and we all need to find a way to become agile and adaptable to overcome this pandemic. Albert Einstein once said, "In the middle of every difficulty lies opportunity." Just because we're experiencing the toughest global crisis in our lifetime, it doesn't mean that you can't emerge stronger and better than ever. So we're going to talk about seeking crisis funding and the criteria that you need to seek funding. So the COVID-19 pandemic has seen all of us lose business during the lockdown. We've lost customers during the lockdown. And the truth is that we are bound to lose several more customers post-COVID-19. So we have to face reality. If there is anything this pandemic has taught us, we need to be agile. So small businesses have been hit hard financially, some more seriously than others. Many are going to need to seek financial assistance to survive. So our approach to the services our accountants in BAN provide your business has always been about encouraging you to invest proactively in financially managing your business well, together with maintaining tax compliance and mitigating tax risk. Now, nothing tests this theory that we've been teaching our clients over the years quite like reality. So this has certainly become evident in the criteria for applications when businesses are seeking financing relief measures. Announced by governments, the Rupert Fund or Oppenheimer Fund, the 4 major banks, they all require a business to be fully tax compliant in order to obtain any kind of financing. And with a recent set of signed annual financial statements prepared by the professional accountant of the business, and they also require the latest 3 to 6 months management accounts, as well as the business owner's personal statement of assets and liabilities. So I'm sure that many of you have tried to seek financing and have come up with these funding criteria. Now, one thing COVID-19 should have taught us is never to make the same mistakes again. So since securing a business loan can be critical to your business survival, don't let these be your roadblock to finding the right type of loan or the lender for you. Now let's look at the type of funding that there is out there. The first thing that you need to consider is what your customers owe you. Do your customers owe you any money as of today? If customers that owe your business money have not yet paid, the first thing you should be doing is picking up the telephone and phoning them. You need to get that money into your business. So you have employees that you are supporting too, and their families, just as they have. So by your customers not paying you is putting your employees in financial jeopardy. So the least that your customers can do that owes your business money and are not able to afford to pay you right now is to settle on some sort of an arrangement between you and your customer to pay off a certain amount over a certain period of time, but not just to leave it. Applying for liquidation of a customer because they're not paying you can be considered, but that should really, really be your very last resort. The other funding that was announced by the government and private sector relief funds was the Rupert Fund or the Sakuma Relief Program. Now those funds have already dried up. and those applications are temporarily closed. Then there was the Department of Small Business Development. They had 500 million, but it's unlikely you would get any funding if you're not 51% Black owned. Then there was a fund from the Department of Tourism Relief of 200 million. Again, unlikely you would get funding if you're not 51% Black owned. And then there were relief funds for SMEs allocated on the 500 billion announced by the president last week. And that still needs to be clarified as to exactly where that and how that's going to be administered. The other way to finance during this crisis is your savings. So perhaps the easiest and certainly the best way to finance your business through this economic turmoil is to use your own money if you have it, or if you have the savings. So in an ideal world, you or your business should save money for a period of time and use this money to fund your business on rainy days. Build up cash reserves for unexpected expenses or unpredictable mishaps. So this is probably the wisest, most conservative and safest way to get through this. But here's the thing. It's an obvious problem with this type of financing is that you are limited by the amount of money you can save. And for how long, we don't know yet. And therefore, cash reserves might even be depleted right now. So the next option we can only look at is taking on debt in our business. And I'm going to talk to you about debt versus equity in a business. So debt, we all pretty much know what that means. It's a loan or a line of credit that provides you a set amount of money that has to be repaid within a period of time. Now, most loans are secured by assets, either your private personal assets or by assets in the business, which means that the lender can take the assets away if you don't pay. Equity, on the other hand, is selling part of your business or a company, for example. And it's known as selling an equity stake, selling some of your shares in your business. Now, in this case, you don't have to pay the money back because it's an investment that the new owner is bringing into the business. In other words, they're going to be a partner in your business. So they will get all the benefits, they will get the voting right of the shares, and they will get the dividends of the profits and associated with equity stake. Now, with equity, when you put money into your business from savings, that is also regarded as an equity injection. Now, regardless, all financing solutions consist of either debt, equity, or a hybrid combination of both. So keep in mind that there are no good or bad solutions. However, finding an investor to buy equity in your business right now or the months following lockdown is probably highly unlikely. So equity would be out. So let's have a look at an overview of some of the common debt financing that you could possibly look at. Refinancing of assets, that this would really relate to those of you that are in the manufacturing industry. You've got machinery, you've got equipment to produce what you make. You're not talking about assets such as tables and chairs. There's no value in that, but we're talking about specific larger machines where you might have an installment sale over it or financing over it. It might almost be paid back. It might be fully paid back, provided that those assets can still have a useful life to generate a lot more income. You could consider going to the banks and actually refinancing those assets and bringing more cash injection into your business. Then you can find financing from a reputable bank. Now, each of the top 4 banks, Standard Bank, FNB, Nedbank, and Absa, have all offered different financial relief measures. So check with the bank that your business account is with. Applying for or extending an overdraft facility is one option, as is a revolving credit loan is another option. Again, the criteria for financing, the slide that I showed you before, is going to come into play here. The other one is to look at credit cards, whether it's your business credit cards or your personal credit cards, which provides a revolving sort of facility that can be used when needed and paid back on a regular basis. And you could also consider taking money out of your home mortgage access bond or your retirement plans or insurance policies and use those funds to run your business until it gets back onto its feet again. But I want to warn you here. This is a very risky strategy because if the business fails, you stand to lose your house, your retirement annuity, and your insurance. Let's say it's the life insurance. So I would also strongly advise against it if your financial plan and cash flow projections result in potential commercial or technical insolvency, which we'll talk about later. So remember, your business must make enough profit after tax. Yes, you've got to pay this government back. And after you take home a salary, and it needs to generate positive cash flows to repay debt. If that is not achievable after you have prepared a financial plan and cash flow projections, then I would strongly recommend that you do not consider this as an option. Then we've got family and friends. Hopefully some of them might be able to help you out. Now, a final word on taking debt. A financial plan projection for the next 6 months at least, I would take it, as I said, up until February next year, if possible. And the cash flow projections are expected to ascertain what your loan requirement is. How much money do you need to survive this thing? And to analyze free cash flows in your business to see whether it can, in fact, repay its current debt as well as extra debt that you've received from financial relief borrowings. So before we begin, let's just sort out some terminology here so that we all understand, that we're all on the same page. So you've heard me throw around the word financial plan, tabs. So what is a financial plan exactly? And what are cash flow projections actually? Now, a financial plan must have a purpose, a goal in mind. Right now, I'm going to be showing you a financial plan that's going to get you into survival mode. Most purposes of a financial plan is growth, okay, or growing a business. So we just need to survive this thing right now before we can even think of thriving. So give us 6 months, maybe until February next year, just to get through survival mode. Now, some other words that can be associated with a financial plan, some people might call it a budget, or projections, or forecasts. Now, they're all exactly the same thing. The only thing is, when we talk about a budget, especially small business owners, there's no real purpose in mind of a budget. It's just saying, well, these are my expenses, and this is my income, and this is my balance in my bank. A financial plan is very strategic. It's different. It's like a budget, but it's not, because it has a specific purpose to it. Projections and forecasts, same thing. Financial plan is a projection or a forecast of future financial results. And it's the process of financial planning in business. It's designed to forecast future financial results and determine how best to use your company's financial resources in pursuit of your business's objectives. This objective we have right now is a short-term objective, not a long-term objective, which would be growth usually. The short-term objective is survival. So I would like to bust one of these myths that many small business owners have. Many of you might be thinking that having a guess at what your expense is going to be, the cost of sales, and heaven forbid your turnover, because how can you possibly guess that right now? You don't even know when you're going to get back to work with this level 4. You don't know how long it's going to last. And you might be thinking to try and project this for 6 months is pointless and a waste of time. There's no crystal ball, so how can you possibly guess? After all, it's only going to be guesswork, so how can that possibly be useful? Because financial planning involves looking well into the future, it is a highly creative thinking process as well as an analytical one. So it is absolutely doable. So I'll show you a practical example later. So having no financial plan is going to be detrimental to your business in this economic environment, and you can get back to starting your business. Now, global research backs our own experience in South Africa. Many of our band accountants will back this up. And that is that the number one failure of small businesses is the lack of direction. So business owners often fail to establish clear goals and to create plans to achieve those goals, especially when they start out business, when they fail to develop a complete business plan before even starting their company. Now, here's the thing. Post-lockdown, once you can get your doors open again, is going to look and feel like starting your business all over again. Cash flow projections starts off with the cash amount in your bank plus any debtors that owe you money, in other words, customers that owe you money, which is increased by the expected inflow of monies from your sale projections or loans that you might receive in your business, financial relief loans, and decreased by estimates of money paid to you as a salary, and to cover the business's cost of sales, other products if you're in retail or wholesale, or salaries if you're in the service industry, as well as the fixed costs, which is your overheads or expenses. So our focus in this webinar, we are going to focus on financial survival as our short-term objective. So as a consequence, there are business essentials that you need to master. And the first task that you need to do is to create a whole household budget, and you need to stick to it. You need to ensure that you are not spending more than your business can afford to pay you. Now, this is assuming it's after lockdown, you first day back at work, you're going to have this financial plan all prepared so that you know exactly where your business is headed and how much money you're projecting your business can afford to pay you. So preparing your household budget is critical to establishing precisely what your monthly salary from the business needs to be. It needs to be a fixed amount every month. Your household budget will create a complete financial picture of your household income. Quite frankly, the purpose of ensuring your business survival through preparing a strategic and tailored financial plan is lost entirely without one of its biggest expenses not being correctly catered for, and that is you. Your business can survive COVID-19 provided that you put in all the discipline you can muster up to keep your household expenses under control and within budget. In fact, this is where every business owner should start, with their household budget. Even if you have been one of the lucky few that has been able to trade during the lockdown due to being recognized as an essential service provider, business is going to change post-COVID-19, even for those businesses. So we need to be ready financially for the impact, and it starts with our household budget. So you need to, in your household budget, also save and put a little bit amount away for unexpected costs, just as you would need to do in your business, and build some cash reserves. You need to curtail non-essential expenses or expenditure. So people won't be going in the morning to buy that first cup of cappuccino before they go to work anymore. Things like that are going to change. Budget for holidays only once your business has gone from surviving, which we are doing right now, to thriving, which it will do, and it will be achievable later on. So if you can maintain your household budget, your business will really thank you for it, because you would have given it a chance at survival. Now, there are certain business essentials that you are going to need to master before you can work on a financial plan. And the most absolutely critical is marketing and sales conversions. That's your ability to determine, especially in this environment, the right service or the right product to the right customer at the right time, and being able to sell it. Finances and financial management, which is your ability to acquire the money you need, the cash in, and account for the money you receive. And then finances means establishing tight financial controls, good budgeting practices, accurate bookkeeping, and up-to-date accounting records. Financial management, on the other hand, means planning and organizing, directing and controlling the financial activities such as procurement, which is sales, and utilization of funds, expenditure of the business. Another business essential is regulations. Your ability to deal with the requirements of government legislation at all levels, including taxes, labor, industry regulations, and so on. Operations is your ability to produce products or services at a high enough level of quality and consistency over time, and to get your product or service to the market in a timely and economic fashion. And labor, your ability to find the right people you need, and the emphasis on the word right people. Deal with unions, establish personnel policies, training, especially training of your labor force, and organizational development, ensuring that there's a high degree of competence and capability and integrity on the part of all the staff members, having a good internal efficiency and time management, clear job descriptions for your staff, accompanied by clear and measurable output and responsibilities. In other words, key performance measurements. And lastly, your ability, and most also very importantly, especially during the coronavirus time, is your ability to continually innovate and produce new products or new services, as well as new processes and responses to customers' needs, and also responses to your competition. So you might be asking yourself, isn't financial planning or budgeting just guessing some numbers or future trading and putting them together and hoping for the best? What has mastering these business essentials got to do with financial planning and cash flow projections, you might be asking? Well, it has everything to do with preparing a financial plan. Mastering these business essentials will create the strategic thinking that you will need to apply in developing your financial plan and cash flow projections, especially in survival mode. Now, I'm going to spend a little time on this all too important business essential, and that is marketing. Having a good marketing strategy goes hand in hand with a good financial plan. You must remember one thing, and that is a financial plan cannot work without a marketing strategy, and a marketing strategy cannot work without a financial plan. They both go hand in hand together. Now, let us also remember that South Africa was in an economic recession even before the lockdown, and now shaken further by the coronavirus, so consumers will be hesitant to spend and harder to convince. Choosing not to market means choosing to leave your revenue to chance, and this can have a detrimental impact on your business's income. It can prove to be disastrous if you respond to uncertainty by only concentrating on protecting your current income rather than growing it. So marketing is an investment in your business. It is not an expense in neither cash nor time. Marketing is the fundamental core of any business. It is the cash flow generator. So loss of momentum in marketing and successful sales conversions leads to a decline in cash inflows in the business and the eventual collapse of the business. So the only option many small businesses are going to have is to trade out of trouble. In other words, increase sales. There are many elements to marketing, but I'm going to focus on the key ones that you need to get right, and that which has a direct effect on the strategies behind financial planning and business survival, especially during these very trying times. If anything this economic lockdown should have taught us in business is to diversify. Don't put all your eggs in one basket. No one customer should take up more than 5 to 10% maximum of your total annual turnover. Now, to rectify a dire situation like this, because it's high risk in any business, you'll need to put your foot on the marketing accelerator as soon as any customer becomes a large chunk of your business's turnover. You must dilute your business's turnover as soon as you become aware of the situation, as you are putting your business at considerable risk if that customer had to leave your business for whatever reason. And some of you have probably found yourself in this very situation right now. So one reason why employment has become so risky in today's new world is because there is no diversification of income. There's just one boss, one company. You lose your job, you lose your entire income. What are consumers' needs right now? So as in any major economic crisis, business will change, people will change. In the middle of this economic crisis, it's important to put yourself in the shoes of your prospective customers or clients. Explore whether any of your products or services have become irrelevant in a radically changed business environment. It is vital that you reposition your services or products towards the current needs of your customers and potential new customers. You need to also think of ways how you can diversify your income stream. So, for example, people will be harder to sell to. So many won't have the disposable cash or income that they once had. So let's take a business. Let's say you've got a gardening services business. People might now decide to mow their own lawns and cut their own edges themselves to save money. But they might not be equipped to pruning trees or cutting back large overgrowth. So if you lose some customers temporarily, let them know about other revenue streams. Quality and service excellence. Business owners also need to make sure that their product or service is as good as it can be. Nobody is going to put up with average service right now, and it will be difficult to get repeat business or referrals. Now, pricing your product or service is actually an element of marketing. I'm not sure if you knew that. Knowing what people are willing to pay for a specific service or product is crucial to know. So from the financial perspective, knowing how to cost your products or services based on your market research is vital to any business survival. Developing your own key message that is relevant in these uncertain times is an incredibly effective tactic in any marketing campaign to get the attention of potential customers. Now, that unique key message should talk to the very emotions that a person might be experiencing in this volatile phase that should immediately pique their interest and offer a solution. So ensure that your key message is as compassionate and empathetic as possible in light of what we're going through. So perhaps make the content more educational or offer specialized help if you have the ability. So for a good example, a key message that is relevant right now for lawyers, they could use something like this. Non-paying or late-paying customers, question mark. We have recovered millions for our clients. You pay nothing unless we collect. That's talking to a lot of small business owners that might be owed money. And so it's relevant at this particular time. It is to some extent compassionate and empathetic to those businesses that are suffering financially. Or let's say if you're a hairdresser, to market you could say something like fretting over unkempt lockdown locks. Choose liberation. Choose T&M hairdressers. Those are the kind of key messages that you could possibly send out. Have you thought about how you are going to create more certainty to replace lost revenue in an uncertain COVID-19 situation? Now, while these are challenging times, there has never been a bigger reason to invest in marketing, more specifically, digital marketing, as there is at this particular time. And neither has there been a greater opportunity, because digital marketing has never been more important for your business right now. This is because during the coronavirus pandemic, people are going to be spending more time indoors and they'll be using their leisure time engaging with content online, such as consuming more social media, shopping online, and so on. So this presents business owners with a unique opportunity to employ digital marketing, such as social media, LinkedIn, Facebook, Instagram. You need to improve your website content and optimize traffic to your website through marketing initiatives, such as maybe holding digital events like webinars. Engage an SEO expert, which is a search engine optimization expert. Place Google Ads and embark on email communication to replace customers or clients that you've lost for the present and to grow your business and different income streams for the future. So this is how businesses that are in shock at the loss of their customers, who have not marketed, as they've only ever relied on word of mouth, are going to replace lost customers or clients. So if you don't have a CRM system, then you need to get software. CRM is a client or a customer relation management system. Now, a CRM system is a digitally recorded database of all your past and your present and potential customers or clients. And if you don't have this software, this should be your first port of call in aligning yourself to a new digital world. And digital marketing means researching where your customers can be found online and how different approaches and tactics might impact your success. You need to set up systems that can test and measure each of your digital marketing initiatives to see what does work and what does not work. There is no point in throwing money at marketing and receiving no ROI. In other words, return on investment. You need to be able to measure your marketing ROI. If you were never a marketer, now you're going to have to be a marketer. Or you are going to have to hire a social media or Google ad or SEO expert. That is just the way things have to be. We do not know how long this economic catastrophe is going to last. So marketing is really the fundamental core of any business. And its key to resilience is the development of ongoing marketing strategies to mitigate against your business loss. So make sure that you have thoroughly developed all digital advertising and marketing campaigns, including social media platforms such as LinkedIn, Facebook, and Instagram. So we understand the marketing and why we don't have guesswork when we look at sales and turnover, when we get to the financial plan. But why do you need a financial plan? The process of financial planning in business is designed to forecast future financial results and determine how best your company's financial resources in pursuit of your business's short-term and long-term objectives. That is why you need a financial plan. So it's in good times as well as in bad times. 99% of small businesses in South Africa don't have a written financial plan because they think it's too complicated, or they don't know what exactly it is, or they don't have enough time to work on one. Well, now you've got no excuse. You've got plenty of time during lockdown to work on a financial plan. So as I have already mentioned, having no financial plan will be detrimental to the survival of small businesses in this economic winter. So a financial plan, you can make informed financial decisions going forward. As we do not know how long this coronavirus pandemic will last, it is important that businesses are proactive in assessing their risk and vulnerability from a financial standpoint and to make informed financial decisions. So COVID-19 directly affects businesses' continuity as business operations reduce, the income reduces, supply chains dry up, and consumer demand plunges. So these risks may quickly lead to solvency and liquidity risks. So if business is to persist in this environment, it will be required to act quickly and decisively to mitigate these risks well in advance so as to plan for recovery and address the related impacts on solvency and liquidity. Now, cash is king in business, and the key is to know what your cash inflows and your cash outflows are and when they will occur. These are vital for cash planning and the survival of your business. So cash flow projections will determine how much money your business will need and when it's going to need that money. Knowledge of cash flow links directly to commercial and technical solvency, which I'm going to show you just now. So it is vital to know in advance whether borrowing monies to survive might not just throw your business into insolvency, which it could do, and land you as director in real hot water for reckless trading. Using a financial plan will assist you in obtaining finance as well, and it is the roadmap to business survival. Right, let us look at the key performance indicators in any financial plan. We're not going to look at it in this order. I am going to be showing you how to do your own budgets or financial plan, but it's going to be a very different way than what we would normally use when we have a growth plan. In a growth plan, we would try and start off with the cost of sales and turnover. So that's why I've got that at the top, but we're going to do it in a completely different manner. Cost of sales, the projections or direct costs, and gross profit projections, overheads or expense projections, and net profit projections, which is actually very important. We're going to focus on that, and cash flow projections. So we are now ready to start preparing our financial plan and our cash flow projections. So let me see if I have no problems in trying to move this to my Excel worksheet, and there we go. Right, I have already set up an Excel worksheet that that's going to focus on survival or financial survival for at least the next 6 months. And all the formulas are already in the worksheet. I've already developed it simply because we don't have the time or the patience to show you from scratch how to put it about, but you can get a general idea of how we're going to start this financial plan. Now, I'm going to use an example of a services industry, but before we do, we missed a poll earlier.
So there we go. We have got 80% in the services, professional events, other sector. The next one is 9% for retail or wholesale, 6% manufacturing, 1% primary farming, and then only 4% I do not own a business. So there we go. Back to you. Thanks, Monique.
Thanks very much for that, Shane. In fact, that was actually my guess, is that most small businesses are in the services industry. So what I'm going to be showing you now is pretty much a financial plan for 80% of you listening in right now. And this is specifically for the services industry. And then I'm also going to toggle to the retail wholesale, which I see that's 9% of the listeners. You've obviously carrying inventory or stock. So, and then manufacturing as well, I think is 6%. You will also be carrying inventory or stock. So I'll briefly cover that, but I'll spend more time on the services section. Okay, so our financial plan, you need to do it for at least 6 months. Now, you might say, when do we start? Now, if tomorrow was not complete lockdown, you could open your doors tomorrow, you would start from the 1st of May. So basically, it's going to be from when you can actually open your doors and start trading. Right now, it's very, very difficult to venture into how do you financially survive when your doors are closed, okay? The only way you're going to manage to do that is one of those financing options that we went through earlier on in one of those slides. Because businesses are still having to pay certain utility bills, but they are generating zero income. And that is a huge problem. So the only way really then, if you haven't got the cash reserves and you haven't got the savings, is to look at debt financing. And of course, you've got to have all your application criteria ready as well. Now, this is when you start opening your doors. As I said, business is going to change radically. And so we're going to start off. I've made a very short list of overheads. Obviously, your overheads would be unique to your business. So these are what we call expenses. They are called fixed costs, okay? So in other words, you would have these expenses irrespective of whether you've got revenue or not usually in the business, or no matter what size your revenue is, you would have certain fixed costs, okay? So when you prepare your fixed cost projections, prepare it as though you were going back to business as normal, that you're going to go back to your office and you're going to open up your office and you're going to continue trading as normal, whether you're an estate agent or a lawyer or an accountant or event management or whatever business you might be in. And from your management accounts that your accountant has prepared for you, or your financial statements, you can see and you can list all the fixed cost items. So this is a very brief one I've done. So when we list these things, you've got to bear in mind that you're going to have some annual expenses as well. This must come into your projections on a monthly basis. So for companies and for closed corporations and even for sole traders, you're going to need annual financial statements prepared by your professional accountant or yourself if you can do it yourself in terms of the various laws. And you're going to need that done first before you can even submit your company or your closed corporation's tax return. That's an annual expense, and so is the tax return an annual expense. So you need to bring that into your average monthly fee. So let's say your annual expense is 10,000 Rand. you are going to take the 10,000 Rand, you're going to divide it by the number of months that you have left until your annual financial statements and your tax returns are due. And you're going to incorporate that amount of money as a projection in your fixed cost projections. So let's say for accounting fees, it's going to include our annual projections. We've also got RP6s, which is every second biannually. Also biannually, you have things like payroll, for example, the reconciliation, the EMP 501 employer reconciliation. These are all kind of biannual and annual costs that you need to bring into your projections. If you don't, you're going to really run into deep water. And you need to bring it in every single month. So let's say, for example, the accounting fees, maybe it's 2,000 Rand or 2,500 Rand a month. And then we're going to provide an additional, say, 1,000 Rand a month. So we make it 3,500 Rand a month as our provision for our accounting fees, taking into account annual and biannual expenses. Now, you're not going to actually pay that full amount. So your accountant will charge you the 2.5, say, every month. What you are going to do, and this is tip number 1, is to open up a call account and put that other 1,000 Rand, take it out of your operating business account and put it into a call account every single month so that you can have the cash flows. When those bills come, you've already got the monies to pay for it. If you don't do this in your financial planning and you don't physically take out the money, you're going to spend the money. And you're not going to know from a cash point of view whether you're in trouble or not. And this goes with any annual expenses. Workmen's compensation is an annual expense, for example, due in March every year. I don't know if many of you are going to be paying bonuses to your staff. I doubt it very much. But if you're in that fortunate position that you can, you would want to put that, also open up a separate call account for bonuses and put away a monthly figure that's going to equate to the amount of bonuses that you're going to pay at the time you're going to pay it. So that's really tip number 1 in financial management. So financial planning means strategically thinking when you put those numbers in, what are you going to do with those figures? How much of the cash is actually going to go out? Well, in this case, the whole 3,500, some's going to go to the accountant and some's going to go into a call account for annual expenses. So let's say our bank charges. Now, all of these figures that we're going to be picking up now is going to be our historical trading figures. So you've got a set of financial statements done in February 2019. That should have been done already 6 months after February 2019. If it is a February year end or a June year end, it should be done by December. You will take those financial statements or the management accounts even better than your accountant is preparing for you. And you can pick up these figures every single month on that. Okay, so bank charges, let's say it's 800 Rand a month. Now look at the formulas, what we're doing here. Do you see that the same amount is going through right throughout all the months? Okay, because these are fixed costs. Look, it's not going to be exactly 800 Rand. It might be 775 Rand the one month, and it might be 810 Rand the next month. At the end of the day, we're looking at an average. It's not perfect science. So computer consumables, let's say, and licenses, which would be software licenses that you might be paying for in your business. Let's say you are a travel agent, you might be paying a certain license fee to use software as a travel agent. That will come into your computer and consumables. Your computer consumables, I don't know, that's if your keyboard packs up, you'll replace your keyboard. I would also put things like ADSL lines or fiber lines and things like that in there as well. And also backup systems, if you're paying for data backup and cloud-based backup, that will all probably go into that category there. So let's say that's 2,000 Rand a month based on your previous historical trading. I can't emphasize that more. Now here comes your household budget, okay? This is your salary or the remuneration that you've worked out that you need every single month to live on. And you might ask, but why is that a fixed cost? Why is it not part of the cost or the salary cost in generating sales? Now, you can split up your salary accordingly. We'll get to the cost of sales just now in the service industry. And you could say half of it is used directly to produce sales, and the other half is basically to run the business. So you've got marketing. I mean, business owners wear 9 different caps. You're a marketer, you're a sales converter. Because you marketing or sales conversion, you're still an indirect fixed cost. You're not generating revenue yet. It's only when you actually physically do the work that you generate the revenue. So for example, if you've got the garden service company, it's the guys that are on the back of the bucket that's actually doing the weed eating and doing the cutting of the lawn that are generating the income. You sit in your bucket and you're making various customer calls and so on and so forth. You're not necessarily generating the income. So you've got to look at this in a strategic way, whether you are a fixed cost or whether you are actually part and parcel of generating sales. So I'm going to say, for example, that the salary, we're going to put the full salary of you as the director or the member or whatever as a fixed cost. So let's say you come up with a salary of 55,000, that's what your household needs. Then we're going to put through a little provision on legal fees. I mean, as I said, this is really based on your historical stuff. You are going to probably need to hire lawyers, maybe to collect monies, for example, from customers that haven't paid you yet. You need to factor in all these kind of possibilities. This is what we call strategic thinking. So you might say, but I never spent money on legal fees. Well, you might just happen to. Things are changing. Business is changing. And there might be, you might now have a big fight with your shareholder, for example, and you don't have a shareholders agreement. I mean, I think maybe the first thing you want to both do is go, and it's like a marriage. You don't have an antenuptial contract, you have a problem. So if you're a shareholder and it's not going well between you right now, you might need legal fees. So you do need to think strategically. Marketing, now we've spent a lot of time on how important this is. So I'm just going to give this a 10,000 Rand budget, but usually it would be considerably more. Motor expenses, maybe you need to get around to customers, very little. So I'm sure a lot of it's going to be done digitally now. And then you might have some printing and stationery. And you have offices, it's a service industry, you're going to offices, you've got some staff that are going to offices. So let's say your rental, it's 9,000. And then salaries indirectly. Indirect salaries means salaries that are paid to employees that do not immediately generate an income. So in other words, they would be people like your receptionist or your personal assistant or secretary or somebody like that, who are not there to actually work to generate sales in your business. So if you invent event management, for example, you might have a secretary that organizes a lot of things and they stay in the office and they take the phone calls, or a receptionist or somebody like that, while the event manager people are all out there on the field preparing whatever the event might be. They would be then what we call direct salaries, because they are working specifically on the event while the receptionist is not. Okay, security. Let's say you've got offices, so you're going to have security. You should have insurance as well, but we don't have enough lines for all of this. And then let's just say we'll put in an amount for your cell phone or whatever it is, your cell phone bill. Okay, so this is not obviously completely reasonable. You need to look at all your overheads, and you also need to apply your mind to what potential overheads you might have or you might set aside. So for legal fees, for example, let's say you don't have any legal fees, but it could be coming up, okay? What you would do is open up another call account. I kid you not, it's called legal fees. And you put that 2,000 Rand into your legal fees every month. So you've got a little kitty, and when something really happens, you've got the monies in order to pay for it. Just some tips. Okay, so now we've got fixed overheads, fixed cost overheads of 101,100. Usually, as I said, the remuneration to the owners is usually the highest, and this is based on historical. So we haven't changed anything. We haven't looked at the coronavirus situation. We haven't said, okay, we need to get rid of the rent. We're going to have to try and reduce some of these overheads. Now, guys, when it comes to doing something like that, okay, you need to look at your lease agreement. You can't just decide not to pay rent. You need to, first of all, look at your lease agreement, and you need to negotiate with your landlord to see whether they are open to at least some kind of a rental reduction But look at your lease agreement, because if most lease agreements, you will sign personal surety if you are trading in a company or a closed corporation. And you don't want a situation where you suddenly stop paying and you've got personal surety, and then they can sue you directly and take your house away. So that's the last thing you want to do. You want to think very carefully about what you do and how you cut certain things out. So we'll come down to the cash flow projections, see what those results are, and we'll come back up here to the overheads and see what other possibilities we might look at to try and save this service business. Okay. Right, so this financial plan, because we're in survival mode, we are going about it back to front instead of front to back. Okay, so the strategy here is we've got to work out exactly what our gross profit needs to be in order to pay its overheads. Okay, so this is what this table is about. So we know what our overheads are. It's 101,100. We don't want to force our gross profit to be exactly the same. You need to build up cash reserves for things that could happen or financing that you might need in order to repay loans. Anything can happen. Your laptop could explode, or you've spilled coffee all over your laptop. You might need to replace it. So you need to build in some kind of cash reserve buffer. So let's make it very lean. I'm not ever keen on a lean margin, net profit margin, but it is coronavirus. We are in survival mode. So as in survival mode, let's just say that we are going to make a gross profit just a little bit more than our overheads. So we're looking at a net profit of 1,400, which is really very risky. But let's carry on with our projections. So we know what our overheads are. We've now forced what our gross profit is. And this is the important thing, is this financial plan is going to force you to make that gross profit to cover your overheads. And remembering that your overheads is very much you here. Okay. Right, now we've got to the point where we know our gross profit and what our net profit is. The question is, can we make the turnover? In order for us to get that kind of gross profit in the service industry. Okay. So now we're going to need to look at what our cost of sales are, or our direct costs. Okay. And then in a service industry, it's your people. If you're in a manufacturing industry, it's your labor plus your raw materials. So let's just say now for each one of these, we've got 3 employees, just as an example. And let's say employee number 1 earns 18,000 Rand a month. And employee number 2, let's say, earns 23,000 Rand a month. And let's say employee number 3 earns 25,000 Rand a month. Now you already know these figures. So after lockdown, maybe you've got some of your staff you aren't able or can't afford to pay them. So you've applied for UIF. In the meantime, some of you might have even had to put your staff on short time. In other words, don't work 8 hours. We're going to cut your hours to 4 hours, and we're only going to pay you for 4 hours. So some of you might have taken a lot of these steps already. Remember that we are looking at a situation when you're opening your doors. Can your business survive in such a changed business environment? And that's what we're really going to be looking at here. Survival mode. Okay, so you've already probably taken action to survival mode during lockdown. We are looking at survival mode post-lockdown. So our salaries and all our cost of sales would be those amounts. It would include things like UIF, skills development levy. I'm not going to get into the nitty-gritty details of all of this. I'm trying to make it as simplified for you as possible, but obviously you've got to consider all of those expenses as well. You know, your union fees and those kind of things. Okay, so now I've got this as a formula driven. So we know we have to make 102,500 Rand gross profit. We know what our cost of sales are because we're a service industry. It's our people's salaries. Then there's a formula that I put in and said, what would the turnover need to be in order for us to pay our salaries, cost of sales, and to pay our overheads and our own salary? Okay, and it comes out at 168,500 turnover. Okay, so it comes out at a 61 gross profit margin, which is quite high for a service industry, to be quite honest. Normally it ranges around about 35, 40, 45, 50%. But now we know what that turnover is. Now the question is, we can't just guess that turnover and say we can do it, can we? We don't know if we can do it. So now we need some strategic thinking behind all of this. So now we're going to get back and we're going to drill down and we're going to say, right, is it possible paying these salaries that these employees can in fact generate that income? So now we're going to look at what we call labor capacity. Okay, now labor capacity, this calculation that I've done is based on an 8-hour day and a 5-day working week. So obviously you would use different formulas if yours isn't an 8-hour day or a 5-day week. Right, so labor capacity means how many hours are there in a day or in a month to generate the revenue projection that we need up here. Okay. So labor capacity, we've got 365 days. This is the days in a year, and these are converted into hours, and we're using 8-hour weeks. So 365 days in a year converts to 2,920 hours. From that, we've got to take off weekends. There's 52 days in weekends. There's 12 public holidays. I'm using 15 working days annual leave. Obviously, you've got to put in whatever your contract says. If it's 20 days, you've got to put in there 20 days. Sick leave is in terms also of the basic conditions of Employment Act. Usually it's 30 days in a 3-year cycle. So I've averaged it at 10 days per year. Then there's also an entitlement of family responsibility leave. I haven't even put in here paternity leave. I believe that came out last year sometime. So that would also be deducted. It's not that all the staff are going to take it, but you need to obviously account for it just in case. And then we spoke about training. We spoke about labor, and one of the critical elements in business is understanding everything about labor. Training is obviously an important aspect of all of that. So let's say we close the shop, close our office 1 whole day a month and dedicate that to training. Now, so far, we have used 8 hours completely productive as working. And quite honestly, as human beings, especially in the law and the accounting professions, it is impossible, humanly impossible, to work flat out for 8 hours in a day. So we've got to be reasonable here. And we're going to say to ourselves, there might be non-chargeable hours. In other words, hours that we can't really bill our clients, or maybe we had a headache and a bad day, or a bubble us in the morning or whatever, and we only got going at 10 o'clock in the morning. We need to allow for some of that as well. So let's just say they can work 6 hours a day rather than 8 hours a day over an average of a year. That could be 60 days. So, and it will take off, obviously, the relevant hours. So before we had the 60, let me just show you an average amount of days that an employee would work if it's an 8-hour day, 5-day week is 21.71 days, 21.75 days, or in other words, 174 hours. Okay. But now that we're going to allow for headaches and all sorts of other human things, we're going to say, right, let's just take off 2 hours a day for the rest of the year. And effectively, those 3 employees up here, employee 1, 2, and 3, will be able to only generate 16.75 days work, or otherwise 134 hours in a month. Now, how is that going to impact on our turnover, and is it achievable? Okay, so this is strategizing. The next thing we're going to say is, right, let's take each one of our employees, employee 1, 2, and 3, and we're going to calculate their hourly rate. Now, guys, it doesn't matter what industry you're in. When you do a quote, you need to know what your hourly charge out rate for each one of your employees are. Any service industry that you are in. Because from that, you can really determine if that person is making money for the business or isn't making money for the business. Whether you are in events management, whether you are in catering, whether you are, whatever you might be doing, there's only so many hours a day. There's so many muffins that employee one will be able to bake. The oven will have a certain capacity for baking, and that employee has a certain capacity for mixing, etc., etc. But there's going to be a price tag to her in the kitchen, as well as a price tag to the equipment and the raw material. Same as in printing and copying. There's going to be a price tag for every single person working in a printing industry as well. And you need to know what that is to see whether each one of those individuals, as well as those machines, so it's the individual and the machine and working the machine, if it can generate the turnover. And this is the strategy behind financial planning. I'm not going to go into massive detail because this is a very simple business example I'm using, a very simple service business, but it can get more involved and complex. Obviously, if you are in a sort of manufacturing industry, a restaurant or catering, or you're making something or the other, it does get obviously more technical. But this is a basis for every single solitary business that provides a service as well. Okay, so we've got salary employee number 1, 18,000, 23,000, 2, and 25,000, so a total of 66. Then because we've got 3 individuals that are generating the income for the business and not the business owner themselves, we will take the overheads, okay, which we'll go back to here. If you remember, it's 101,100, okay? So let's toggle down. We've got 1,100 and we've got 3 employees. Each one of those employees are the only ones responsible to generate that income. So we will split the overheads amongst 3 employees. And each one would have to generate income to cover 33,700. Okay. You'll notice that we don't split it according to salary because the salary is irrelevant to the overheads. The overheads will always be fixed. It's not variable. Okay. The only thing that is variable is our cost of sales or our direct costs. Those are what we call variable costs, not direct, fixed costs. And then we would also look at the profit per employee. So we said the profit was 1,400 and each one would generate a portion of that particular profit. Again, it doesn't have any relevance on the salary amount that you are paying, which means that every employee would have to generate a different amount in terms of turnover. So the turnover projection for employee 1, they would have to generate a minimum of 52,167 Rand. Employee 2, 57,167, and employee 3, 59,167, simply because their salaries, the salaries are getting higher. If you add all 3 together, you get the turnover of 168,500, which we said we needed to achieve here just to break even. Okay, so do we understand how now the services and how each employee will generate that particular turnover? Now, of course, the question is that doable? How many hours can this person, in fact, if you have a look at the formula here, can this person, in fact, generate 134 hours? Do you have enough customers or clients that are going to generate 134 hours that each one of these employees need to achieve? So employee 1, based on a salary of 18,000 and the overheads that we've spoken about, that charge out rate, minimum charge out rate to achieve the 168,500 turnover with a very small profit margin is 389 Rand 30 per hour. Employee 2 hourly rate is 426. Now, and then 441 Rand 54 is employee 3's charge out rate. So if you have a look at the formula there, it's based on this 134 hours. The minute any one of these employees cannot generate 134 hours because you don't have enough work for them, that is when you now start to need to use different tactics. What can you do? Because then you're going to start running at major losses. They can't generate that. And this is what we need to know. We need to know, is that doable? Do we have enough customers that we can sell that kind of time to? Now, whatever industry it is that we're using. Okay, so now you understand how we get to the charge out rates. Let's just see what this scenario has on our cash flows. So here's our financial summary. So we need to achieve, when we open our doors after lockdown, 168,500 minimum every single month. Our cost of sales, which are our direct salaries, gives us a gross profit. And now remember, we force the gross profit in this scenario, okay? Because that is the minimum we need in order to pay ourselves and all the other expenses that you saw, the overheads that you saw, leaving us a small margin, net profit of 1,400. Okay, so now that we know that summary, we're now going to look at the cash flow projection. So if you are in a business that sells cash, or then you're probably in a much better situation than a business that offers credit terms, say for instance 30 days. So for this example, I have taken some of the customers or clients that pay this business. They pay a retainer every month. So in other words, that is money that they pay upfront before the service is done. And it's not a deposit, okay? A deposit is something quite different. So in other words, they pay for the service upfront. And then the next one, I said, right, the 30-day customers, they've got credit. They are 70% of my entire customer book. And then we have some stragglers. They're on 30 days, but they're not performing. And let's say 10% of them are paying later than 30 days. Now, I've used percentages here in terms of cash inflows. It's probably one of the easiest ones to do. But, you know, if you are selling to certain customers and you've got a fixed customer book, you can pretty much know how much your retainers are if you do charge retainers. And guys, I would really stress in these economic times now to start doing that. Or those that are on credit 30 days, you can more or less judge those kind of percentages. But I've used percentages here only to simplify this cash flow projection. There's a lot of other ways of doing it as well. If you're in a cash business, then it's quite easy. Then you've got to determine, obviously, exactly what monies are going to come in because people are going to pay cash as they leave. But a lot of service industries don't work like that. So if you're not using percentages, now those percentages, again, you're going to look at your historical sales to your customers, historically which customers pay retainers, historically which pay on time, and historically which don't. And this is pretty much how you're going to use these percentages. However, if you can't use that in your business because it's impossible to tell, then you're going to consult with your accountant and determine a better, more accurate way of judging these kind of cash inflows. So there are various different options to look at. Okay, so I'm just, as a simplified version, I'm saying, right, 20% of all my customers that are sold this 168,500 Rand to have paid retainers up front. So let's say we did open our doors tomorrow. We know that our customers, 20% of them are going to pay before we do any work in May. So we brought that in as a cash flow. And we've only brought that in as a cash flow because right now our situation is our businesses have been closed for the last month. So it's like starting business from scratch, okay? That 100, whatever you're going to project for the month that you're going to earn the income for, it's like opening your doors and you've had no other sales at all. So you can't rely on any cash inflows other than when you open your doors. And when that happens, you can see now already you've got, out of your 168,000, you've got very little money coming in the first month of trading. Then the 30-day customers, which is still this 168,000, will pay in month 2, 70% will pay. And then we're working on a 10% average paying in month 3. So let's say that was May, June, and July. So July, we'll get in the last of our May sales here. Okay. So those would be our inflows, but if you have a look here, our total sales, I'm looking at 5 months projection in this case, 842,500, but in cash we would have only received 690,000. Right, let's look at our cash outflows. So the first one is the salaries. Now the salaries you will always pay immediately at the end of every month. So you will still pay yourself, you'll still pay your staff. And I've put all the salaries together, so it's your salary plus the cost of sales salaries. The difference is your overheads, so 34,100, which is your printing, stationery, motor expenses, accounting fees, those kind of things. So already we have a situation where your inflow, when you get back to business after lockdown, your inflow of cash, if you do sell on credit, is far less than what your outflows are going to be if your staff all come back to work and they're not still on short time. Okay, so that means we're going to have what we call a net outflow cash movement of 153,400. So let's just say, for example, now we've already used, we don't really have much overdraft, but we've used quite a bit of it. And let's say we start off with 20,000 Rand overdraft when we open our doors. We had some cash reserves, and now we've gone into some overdraft, open our doors, and that's pretty much what our bank balance is as of today, if we were opening our doors tomorrow, which is not going to be the case. If you have any customers still owing you money, you would put in that amount over here because you're going to expect that money to come in at some stage. That is still part, whatever your customers owe you is still part and parcel of your bank. It's just not in your bank yet, but now you can project which customers will pay when. So if you entered into some arrangements with some customers that cannot afford to pay everything right now, and they're going to pay a bit every single month, this is where you're going to bring in those payments. I'm going to assume that no customers owe any money in this particular scenario. Okay, so we have now a situation where with our overdraft, plus a huge amount of cash outflow when we start again after lockdown, we are going to land up with 153,400 Rand doof in month one in an overdraft or a REIT situation. There's going to be interest as well. I mean, I'm just using 10% just to simplify things. Whatever the interest rate is, that's not really an important fact to discuss right now. So we have then a closing bank balance of 154,678 Rand. Now, guys, if this was the real situation, the question is, if you don't have an overdraft facility or you haven't got any financing, you're going to be in serious trouble in month one when you open your doors, as you can see, is where you're going to get that 154,000 from. Now, you'll see also it doesn't get any better afterwards. The following month is also not great because we've got credit. We've got customers paying us some credit or paying off their accounts. So now you might want to decide, okay, I'm going to get some kind of a loan, whether it's a family or friend or whatever, and I'm going to borrow some money. So let's say, okay, well, we can borrow it in month, let's say we can borrow the money in month two after opening. But in month two, something disastrous happens. So we suddenly go and spill coffee all over our laptop, and our laptop doesn't work. We're in the service industry. We need our laptop to work. Now we've got to go out and buy a new laptop. Now you'll notice that capital expenditure has got nothing to do with your overheads. Okay? It falls completely outside the realm of your income statement. It's a balance sheet item. So now you're going to now need to buy this laptop. So let's say you pay 10,000 Rand for this laptop, because otherwise if you don't get it, you can't work. Or one of your staff needs a laptop. So you buy the laptop. Now we've got a situation where our overdraft has gone up even more and we don't have financing. So we look at our financing options, and we were lucky enough to get some money, and we look at, say, okay, well, how much do we need? Here it's telling us. So I would round it up, saying 182,000 is what you're going to need to survive this thing. So we said, okay, well, let's round it up and say, let's get a 200,000 Rand loan. Now with that loan, so we put in the money and we go, yay, we've got some money. And look, our situation's getting better because our money is going up every month. But it's actually not, because what we've got to do is we've got to repay that loan. So let's say it's a loan and it's over 5 years and 60 months. And let's say, including the interest on that loan, we're going to pay back 3,500 Rand a month. Now look what happens. We've got a loan, we've got to pay it off, but look what's happening to our bank. So we're in a positive situation, but look, our bank balance is going down, down, and down. And we continue like this, we'll have no money in the bank again. Now, in the service industry, the minute you've borrowed that money, that 200,000, because the service industry doesn't have major assets, okay? It might have some computer equipment, tables and chairs, desks or whatever, and that's about it. Now, as soon as that money comes in, that company is now owing that money. It's a debt, which means just by borrowing that money in this kind of business, okay, I'm not saying all business, in this kind of business, it means that you've put this company in what we call technical insolvency. And the reason for that is because the liabilities are going to exceed the assets, okay? And you've also put the company in a situation like this into what we call commercial insolvency. And the reason for that is that you don't have enough monies, and you won't have enough monies to pay your creditors on time because your cash resources are going lower and lower and lower. And this is the situation where you get together with your accountant and you fix this. But you won't know this until you actually do these cash flow projections from your financial plan. Okay, I think I've pretty much covered that. I'm just going to quickly show you inventory for those guys that are in retail and wholesale and maybe even some manufacturing. How do you work out your cost of sales if you don't just have employees? Okay, so you're trading in stock, right? So I'm going to give you 3 examples, and these are not all the examples. These are just very basic examples of how you can work out your stock holding. Right, so let's just say, for example, your opening stock is 150,000, just and that's what you've got in your store right now. Your store's closed, the malls are closed, and that's what you've got right now. Maybe you open your doors in the malls tomorrow. This example is going to be using stock turnover days. Now, guys, you can get a lot of this information from an integrated inventory system. So if you've got a good integrated inventory system, this is really going to help you with a lot of your stock calculations. Okay. So what you want to do is you want to say to yourself, okay, I'm not going to increase my stock. I mean, that would be death if you had to do that or consider that right now. So let's try and keep the stock holding pretty much the same as our opening stock holding. So what we're going to do is we're going to force the closing stock at the month end to be very close to what our opening stock is. You can decrease it, but if you decrease your stock levels, also be careful that your shelves aren't going to be completely empty, and it means that people are probably not going to want to go into your shop. So you obviously need to consider a lot of strategy when you think about these things. So let's say your closing stock is as close as possible to your opening stock. Now, because we are in survival mode, right? We're not in thriving mode just yet. We are forced balancing our gross profit to meet exactly the same overheads as our service industries. Let's say nothing changed. Our overheads are exactly the same. So our gross profit, we said we needed, there was 102,500 Rand. Okay. Now the question is, what would our purchases need to be in order to keep or maintain our stock levels? So this you would get from your stock system, or you might know it very well. And let's say you can turn over your entire store stock in 1 month and a quarter. Okay, so 1.25 months, you can sell your entire stock. So a lot of accountants might use days. I'm just using months, okay? Either way, these calculations all vary, but it comes down to the same thing. So let's say your entire stock turnover, you would need to buy 1.25 times your stock in order to get it back to the same stock holding at the end of the month. Which means it forces that your turnover now is 290,500 based on that gross profit. Now the question is, can you sell 290,500 turnover? This is when strategically you're going to start calculating that. That gives a 35% margin. The second example is, again, we're going to use the same gross profit that we need, okay? And what I'm going to say is, right, now you're going to use historically, what has your gross profit margin been? You're going to go to your financial statements, you're going to go to your management accounts, and you're going to get the average margin that you achieve generally. So let's say it's 40% is your annual margin. And let's say your stock holding is, for example, 250,000 in your shop right now. Okay. And again, you want to keep your stock holding pretty much the same. So at the end of the month, we did the same example. So it's going to tell us that our stock purchases is going to be 153,000. Our turnover we will need to achieve to break even is 256,000. Then you go back to strategy, you go back to marketing, you go, can this be achievable? No. This is now when you need to look at your products. You need to see where the customers, if it's relevant for customers to buy. You might need to discard some of those products that are not going to sell because of post-coronavirus. People are not going to be flush with money anymore. You might need to look at different stock holdings. The third way of doing it to work out your cost of sales, if you're in retail or wholesale or manufacturing, is to list all your different products and the cost price. Now, again, this can come off your inventory system. So let's say product one is 35 Rand at cost, only at cost, obviously excluding VAT, and we'll just put in an arbitrary cost price for each one of these products, okay? Then each one you would have different markups on. So you know what those markups are, and you would put in those markups, and again, it should also be reflected in a very good inventory system. That markup, I've already got the formulas in there. It will show you what the value is, the selling price, the margins. Because we've got 5 products, I'm adding up all the percentages of the gross margin, and I'm dividing it by 5 to get an average percentage. So you could have 100, 200, 300 stock items. You would do this for 200, 300 stock items. All you want to try and get to is what would the average margin be. And from that average gross margin, you can work back to what your cost of sales amount is for your plan. Okay, so pumping up your marketing efforts, right, and preparing a financial plan and cash flow projections is going to be vital for you to do right now if your business is going to have a chance at surviving this economic turmoil. And business survival is going to depend on many factors. Adaptability and agility are at the top of this list. And diversifying by generating new or developing niche revenue streams that is an optimal fit to the current needs of potential customers right now, learning from your past mistakes, adopting a growth mindset, and viewing the work that you do in your business with a different perspective are all elements that, if you do it well, should get you and your business through this operating in survival mode and onto thriving. So please remember that some of the best initiatives are built in trying times. Like all difficult situations, this too shall pass. So I've bombarded you with a lot of information this morning. If I've lost you along the way, you can always view the recording on our website at www.ban.co.za and click on our events page. Okay, so that's pretty much the presentation. I know it was a lot of information. Okay, the first one is from Guy Danes. Hi, Guy. Morning, Monique. Critical that SME owners start to redesign themselves, repackage their sales strategy. And as I say, YATM, you are the message. Okay, thanks, Guy. Another one from Guy. Which SME owners have re-looked at their circle of influence? Who is in it and why? Okay, good point. Next one is Dominique. Sorry, did I miss one here? Sorry, also Guy. It is critical to expand who you collaborate with, have conversations with, need to invest in outside coaching. Yes, Guy, I would absolutely agree with that. Coaching is an incredible investment. And I'm certainly a product of an excellent coach I had some years back. So I would totally agree with that. Dominique Smith, are we able to get a copy of this Excel spreadsheet? Yes, Dominique, what I will do is we'll load it onto our website, www.ban.co.za. If you have a look at the events tab and then click on free webinars, you'll be able to download the Excel spreadsheet. Jolene, where do you include the SDL and UIF contributions of the employer? Can you show cost to company in cost of sales? Yes, absolutely. Jolene, in the service industry, as I mentioned when I went through the cost of sales, I wasn't going into the details of UIF and SDL, but yes, you must include it in cost of sales if it's directly related to the employees generating the sales. Otherwise, and then the SDL and UIF contributions, that are related, say, to the business owner or any employees that do not generate directly those sales, you would put that under overheads. Gary Faree, very good webinar. Thank you. Thank you very much, Gary. Norman, thank you for this great Zoom meeting. Easy to follow. Thank you. Great, Norman. It's wonderful to hear that there are people that feel that they have learned something from this. Maria, I need to leave. Thank you. This was excellent. Thank you so much, Maria. That's great feedback. Thank you. Thanks to all the people that attended. You've invested in your business by attending this webinar, and I wish you all the very, very best for when your doors do open.